Well, good morning and welcome to the Reserve Bank. With me I've got John McDermott, who's the bank's Chief Economist and Assistant Governor, and also Willie Chetwin, who's the Head of Forecasting. The Reserve Bank today reduced the official cash rate by 25 basis points to 3.25%. Growth in the global economy remains moderate, but volatility in financial markets has increased. The New Zealand economy is growing at an annual rate of around 3%, supported by low interest rates, high net migration and construction activity, and the decline in fuel prices. However, the fall in export commodity prices that began in mid-2014 is proving more pronounced. The weaker prospects for dairy prices and the recent increases in petrol prices will slow income and demand growth and increase the risk that the return of inflation to the midpoint would be delayed. Inflation has been low due to falling import prices and the strong growth in the economy's supply potential. Wage inflation and inflation expectations have been subdued. With the fall in commodity prices and the expected weakening in demand, the exchange rate has declined from its recent peak in April, but remains overvalued. A further significant downward adjustment in the exchange rate is justified. In light of the forecast deterioration in the current account balance, such an exchange rate adjustment is needed to put New Zealand's net external position on a more sustainable path. A reduction in the official cash rate is appropriate given low inflationary pressures and the expected weakening in demand, and to ensure that medium-term inflation converges towards the middle of the target range. We expect further easing may be appropriate. This will depend on the emerging data. So thanks very much.
Governor Wheeler, with the movements in the exchange rate over the past week or so, or a little bit longer, have you been bounced into this by the financial markets?
No, not at all. We've been saying we want the exchange rate down for a long time. We've been saying that it's unjustified and unsustainable, and essentially that's the message that's still in this statement. And we believe further adjustment is needed. So we've been pleased that the exchange rate's come down in TWI terms, roughly about 7 or 8% since the peaks in April. But we still believe it's got a significant way to go.
Mr. Wheeler, how worried are you that this will just simply put fuel on the Auckland housing market fire?
Well, it's something that we thought about, as you would expect. I mean, Auckland house prices are running at 17% in terms of house price inflation, whereas the rest of New Zealand is house price inflation's around 3%. So the housing situation in New Zealand, from an economic perspective, is very much an Auckland problem. And we've got the median house price in Auckland up 60% since where it was at the end of 2007. That's true for the median house price. You look at indicators such as house price to disposable income ratios, they're around 7.5, and yet they're 4 in the rest of the country. So we have been concerned, as you know, about Auckland house prices. And that's really why we moved on the LVRs, both in terms of the 30% deposit requirement that we want in respect of investor-related lending, and also the 10% limit for LVR lending in general. And the government has moved, as you know, on the tax side. But these are not going to fix the problem. I mean, what's required to fix the problem is more supply. This can help moderate the rate of house price inflation. But in the end, it's supply that's required to to fix the problem. And monetary policy, while we look at the implications for asset price instability, as we're required to under the Policy Targets Agreement, our primary objective is price stability in the 1 to 3% target range and the midpoint over the medium term of 2%. So that was our prime focus here.
You say that the new initiatives won't solve the problem, and that you've thought about the problem in the Auckland housing market, but isn't this influx of cheaper lending just going to put petrol on the fire that is the Auckland housing market?
We'll probably see floating interest rates decline as a result of this. You would expect that. You'll probably see some decline in fixed mortgage rates, maybe 2 and 3 year mortgage rates, for example. But some of this is already priced into the market. I mean, the market was expecting basically a 50 basis point cut in interest rates over the next 12 months. They were unsure how much would be priced in terms of the June MPS, and roughly 50% of a 25 basis point adjustment had been priced in. So that's already reflected in the curves. So there will probably be some adjustment in swap rates and possibly in mortgages, but a lot of it is already built in.
But do you expect prices in Auckland to keep going up now?
Well, we'll look at the RINES data. That's what we tend to put a lot of focus on, and that'll be out in the next few days for May. We would hope to see some deceleration from 17%. Time will tell. But in terms of the measures that we've taken, in terms of the 30% deposit requirement for investors and that, we think that that could slow house price inflation in Auckland by around 2 to 4%. And then the government's measures on the tax side should also be effective as well. But in the end, macroprudential policy can't solve an Auckland housing problem. We can try and help reduce the pressures, but it's ultimately supply that will solve the problem. And that's been the case in Christchurch as well. You've seen house price inflation moderate to 5% or less now in Christchurch because the supply is coming on stream.
The regions are suffering from the dairy price fall. Do you expect to give them more relief in terms of the LVRs you've got in the regions? Could you take them off completely to help them?
Well, we'd like to see, as I've said, the exchange rate lower, and that will hopefully help the dairy farmers, and that'll spill through into the regions. We did raise the speed limit, if you like, from 10% to 15%. We felt that taking it off from 10%, taking it off completely would be just too early at this point. But it is possible if we see more house price moderation in the regions that we could move further, sure.
And are you thinking that could be further cuts if you see wage expectations continue to be bedded low? If you're not seeing the pickup in inflation, are you signalling that there are more cuts coming?
In terms of the forward projections, we've built in 2 cuts. And we've indicated in our statement that, let me find the exact language, we expect further easing may be appropriate, but that will depend on the emerging data. So we'll look carefully at what's happening to commodity prices, what's happening to GDP data, inflation expectations, wage outcomes, what's happening on the exchange rate.
But that's a pretty strong signal to the market and I guess potential borrowers that if they wait a little bit longer, they'll get another cut in 6 weeks.
Well, time will tell based on the data in respect of any future action. But what we have signalled in terms of our forecasting is that we expect we've built in 2 cuts in terms of the OCR. Now that was over essentially a 12-month period. Time will tell, in terms of data, just what action's needed and when.
Governor, can you give us an indication of what you think is a sustainable level of the New Zealand dollar? We've
always avoided doing that. But, you know, the IMF and places like the Peterson Institute are less shy than we are about doing it. And I was looking the other day just at some of the research out of the Peterson Institute. And basically, I think this was done in May, was basically saying the real exchange rate relative to the real equilibrium exchange rate was probably overvalued by about 7% on their numbers. But they wouldn't have built in the latest dairy price or commodity prices.
Governor, 6 weeks ago, you indicated that one of the conditions for a cut was that wage and price setting outcomes settle at levels lower than consistent with your target. The document today doesn't seem to offer much evidence that that condition has been met. So aren't you essentially jerking the markets around with mixed signalling here?
No, I don't think so, Brian. I mean, we've been talking about the conditions around a cut in interest rates since early February. I mean, I gave a speech in, forgive me, I gave a speech in Christchurch in early February which talked about the circumstances under which we would might consider cutting interest rates. I also indicated at that time that we didn't think the conditions were in place. John's given a speech in April, and then we had the messages again in the April OCR. I mean, what's happened is if you compare our forecasts now to those that we presented in March, then the terms of trade that we've built in are 7% lower for 2016. And a lot of that is carried throughout the forecast period. Now, that's two things. A lot of it's dairy prices. Dairy prices are now 30% lower than they were in early March. And a lot of it's also the increase in petrol prices. So in March, we were assuming that the oil price cuts, if you like, and the flow through into petrol prices would increase household disposable income by about $400 a household. Now we think, given the rise in petrol prices, that's probably only around $200 per household. So it's the combination of the dairy prices and the petrol price increases that have accounted for most of the change in view.
Governor, in this report, you mentioned Australia's falling terms of trade and also the housing market. The housing market is helpful for the Australian economy. The falling terms of trade, of course, is not. How helpful has the recent budget been, and are you expecting any impact on the New Zealand economy from that, and will you be taking that into account with further interest rates decisions?
Well, I probably won't comment on the Australian budget position, but Glenn Stevens, I think, gave a speech yesterday where he talked about perhaps the possibility of a further interest rate cut if, and I think he put a big if out there, if it would help the Australian economy. Australia matters a lot to us, of course, because it's the destination for 21% of our exports, similar to China. So we watch what's happening in Australia very carefully. And in essence, there's three big adjustments, I think, going through the Australian economy. If you look at mineral capex, it peaked at around 7.5% of GDP. Historically, it's been around 3%, 2 to 3% of GDP. So it's on the process of going through that again, back to its sort of historic levels, if you like. Second, you've seen a large fall in iron ore prices. Their fall in iron ore prices has been even greater than our decline in dairy prices. And third, they've got a significant budget adjustment over time that lies ahead of them. So there's some challenges there, and I think the governor of the RBA, is clear on that.
Governor, how much of an impact is the strong net migration having on wages and the weak wage growth in New Zealand?
One of the things that has been very interesting is how the supply side of capacity of the economy has expanded quite dramatically in many ways. And it's through factor accumulation. So you've seen the labour force increase by 3.25% over the last 12 months, and roughly half of that's come from migration, about a quarter of it from participation, and the rest is sort of natural increase. You've seen a lot of investment put in place, and that's enhanced the capital stock of the economy. So basically what it's meant is that when you've got the supply side of the economy growing quite rapidly, then it creates potential to absorb the demand growth that's taking place in the economy through consumption and other forms. And that's basically enabled us to absorb the demand growth without seeing those sorts of inflation pressures arise. So you've seen employment growth of roughly 3.25% in the last year, but you've seen the labour supply increase by the same amount. The labour force has increased by the same amount. If that had not happened, you would have seen more wage pressure, without a doubt.
You said your projections have built in 2 cuts. Does that include today's cut, or is that in addition to today's cut? And secondly, where would you like to see the New Zealand dollar?
That includes today's cut. And on the New Zealand dollar, we would like to see it lower, significantly lower.
Could I then just ask, you've covered that you're expecting only one further cut in your current projections. When should we roughly expect that to come? You seem to be saying it's data dependent, because are we looking at the next available opportunity for a cut, or will it be at some stage over the next 6 months?
Well, I think that really will depend on the data. When we're looking, one of the issues was, given that we were forecasting an interest rate track of 2 cuts, one of the issues was, when do you start that process? Having indicated that your projections assume 2 cuts are built in, we felt that we needed to start that process today. Because of the various things I've talked about, the terms of trade adjustment, the difference in assumptions since March, what's happened on the petrol prices. You've seen inflation expectations and other inflation indicators quite moderate. So we're sort of looking out the next 12 to 18 months in terms of monetary policy. We're seeing that demand will probably decelerate over that period in terms of its rate of growth, so that we felt that if we delay, we may well end up with a case where we had to be more aggressive further down the track. As to any other changes, that really will be driven by the data.
And your forecasts also show that once you get down to that lower level on the 90-day bank bill, they don't rise again over the forecast horizon. Is that to suggest that you really don't see any further rate hikes out in the future despite inflation returning to 2%?
Just given the broad macroeconomic conditions, again, it's more internationally driven with those export prices. And perhaps given that we've seen more supply potential that this economy has generated, which is good news, the interest rate track beyond the 1-year horizon is pretty flat.
Okay. Just one third question, if I may.
Yeah, sure.
You'll be aware that the markets were pretty divided on what you were going to do today, and in fact most economists expected you to stay on hold. Traditionally, you've telegraphed moves quite well. I'm wondering, could you give us some insight into your thinking today? Were you actually wanting to surprise the market to some extent?
Well, I know I read the same data carefully that you do, Matthew. No, we've indicated, as I say, in February, if you go back to that speech in early February, I indicated, what would be the conditions under which we would consider a cut in interest rates. But we also felt at that point that a cut wasn't warranted, and we discussed that in the speech, and I've explained the thinking that's led to the cut. But we also addressed it in John's speech. We addressed it in the last official cash rate announcement in April. So I think we've signalled that this is something that we've been thinking about and watching pretty carefully.
Okay, thank you.
Grant, notwithstanding that answer, you have gone a little earlier than was the perhaps consensus in the financial markets. Is there any, and you've mentioned here greater volatility in global financial markets and given a nod towards the potential of an untidy Brexit. Is there any precautionary element in moving now with a view to the possibility of greater volatility as a result of that possibility?
Well, the international scene is a bit mixed. As you know, you've seen some pretty mixed indicators come out of the US, and I think the market was pretty gratified by the 280,000 increase in employment figure, non-farm payrolls that came out the other day. There is some uncertainty around how fast China's growing at the moment. I mean, it grew 7% annual rate in the first quarter, but there's probably, I think, a lot of analysts out there who think maybe the economy's growing at around 6 in China or so. Some better data out of the euro area, particularly in terms of first quarter GDP, and it looks as if they may be out of their deflation problem. And some better data out of Japan just recently. But volatility in the markets is picked up, particularly around fixed income, and you see it in 10-year bonds in Europe, particularly in Germany. And there is a lot of uncertainty, I think, on two fronts. One is when will the Fed raise its federal funds rate? And I think the market has probably discounted June at this point and has moved towards September and is in that September-December period. And in Greece, it has become a very messy situation. I mean, just this morning, Angela Merkel was reported to have made some optimistic comments about Greece, but the comments really are a bit all over the map at present around Greece. You know, that there's two big adjustments to come in financial markets, one suspects. The reaction to whatever happens around Greece, and certainly the Fed raising interest rates at a time when the ECB and the Bank of Japan are still doing vast amounts of quantitative easing. So this wasn't insurance in any sense. We were worried about the decline in the terms of trade, particularly around dairy prices.
I may have missed, sorry, Rob, I may have missed it, but where do you assess the neutral interest rate to be now?
John, do you want to have a go at that?
Yeah, I mean, there's a whole range of uncertainties and lots of moving parts, but we haven't really changed our overall view about neutral interest rates being around about 4.5. Really what we're seeing is the future demand conditions in this economy weakening, and possibly the good news is actually we can actually grow a little bit faster given all the supply potential without generating that inflation.
It's a concept that is hard to get your mind around sometimes because it's, one, unobservable, two, it's linked to whatever the productive potential of the economy is, which is also unobservable. And it's basically a long-run concept in terms of what's the rate of interest that's commensurate with an economy growing at full employment over time and achieving price stability. And, you know, there's some variability in the range of estimates.
Two questions. One is two banks have already cut their floating rates this morning. Floating. Mm-hmm. So I was wondering if you were expected a response that quickly. The second one is a number of economists have sort of been suggesting that you've kept rates too tight for too long, or monetary settings too tight for too long. I think the comment a couple have made is that it's been a long time since you've been anywhere near that midpoint. So I wonder what your response to that criticism is.
Yeah, I would have expected the banks to move quickly on floating rate mortgages, given the cut in the OCR. That's what you'd expect. I mean, if the issue is, Rob, sort of, have we made a policy mistake in essence in terms of raising interest rates last year, because we raised them 100 basis points in the period March through July, and have we delayed cutting for too long? I think the answer is really not at all. I mean, if you go back to the period March last year, when we started raising rates, our terms of trade were at a 40-year high at that point. Our net immigration was increasing quite quickly. We had concerns about house prices. And like other forecasters, we were forecasting a positive output gap. And I don't think any forecaster could have anticipated that dairy prices would fall 55% from February onwards of last year, or that oil prices would fall 60% after June last year. So why we've moved is, as I say, it's linked to the terms of trade judgments that we've built into these forecasts. It's linked to the time in which it will take to achieve our price stability objectives, and particularly in respect of the midpoint of the inflation range. And it's also been the fact, as I said before, you've seen very strong factor accumulation in this economy, which has enabled the supply side of the economy to absorb the demand that's been out there in terms of consumption and spending in general, without generating the sorts of inflation pressures that you would have seen in previous years, without that strong supply side response. But let me just see if John wanted to add anything. Was there anything, John?
Two things to observe relative to that question. One is growth has been growing above potential, and that's been important, right? Unemployment generally has been drifting downwards. It looks more stable at the moment. And the other thing is non-tradable inflation looks very steady. So those are the three areas I would look to if you were thinking things had gone wrong, right? The real reason the inflation rate was not near 2 was the fact that oil prices collapsed and the exchange rate has stayed very overvalued.
Governor, just a question about the fuel prices. You indicated that the windfall gain of $400 a year was now looking like $200. If, as you expect, the currency drops significantly, is that windfall likely to disappear, and in fact, consumers likely to see higher import costs in the next few months?
Well, James, let me ask my specialists on that.
So if I understood the question you're asking, so that there was a one-time windfall gain when petrol prices went to 170 something. We've seen that reverse now to about $2 something. Given the exchange rate potentially could depreciate further, yes, most of that windfall gain will have dissipated.
And sorry, the wider question, I guess, is should consumers expect import prices to rise significantly in coming months if, as you expect, the currency falls?
And that, yes, and that is factored into the forecasts. And actually, if you see the profile, we have quite a subdued consumption profile, as the real incomes, I guess, of consumers are actually less in the current forecast relative to where they were in March.
And just another question on migration. You seem to be projecting a huge drop-off from the current boom. Why are you so confident that that's likely to happen, and is that going to be the answer to the Auckland house price issue?
Well, obviously, picking turning points in forecasting is always difficult. What we've seen is some of the student visas and some of the work visas have just turned slightly. So there's very early indications that cycle is turning. And again, the broader economic conditions would say that would continue further. So whether it's this quarter or next quarter, that's what we sort of built in and expect to happen.
Given that we think over half the net migrations going into the Auckland region, then it does have potentially a big impact on house prices in the following sense. I mean, if you've got, say, net permanent migration running at 50,000, and say half of that, just say half was going into Auckland, and you look at the tenancy ratios, the occupancy ratios per house in Auckland, it's roughly about 3 people per house. You would need 8,000 houses just to deal with the migration inflows. And if you look at permits in Auckland, they're currently running at 8,000. So that doesn't take account of just the natural increase in population for Auckland, and it doesn't eat into any of the backlog in any way. So that migration is a really important factor in the Auckland market.
Governor, just 2 questions from me. The first one is, given how difficult it's been for not only the Reserve Bank but most forecasters in trying to gauge inflation, is the 1 to 3% target with a midpoint still an appropriate target for you guys?
I think it is. I think you saw Olivia Lafourcade, was it, the IMF?
Olivia Blanchard.
Olivia Blanchard, forgive me. At one point he came out and said, look, said it was a personal view, but, would a 4% inflation target be more appropriate given the zero lower bound and give central banks more scope? I don't think he got a lot of support for, as I say, what he said was a personal view. The 1 to 3% inflation target still seems appropriate to me. I think the emphasis on the midpoint for the medium term is also appropriate. I think it's also true to say that it's become a lot harder for central banks to, given all the uncertainties around monetary policy and the way it works and the lags, etc. You're in a world of just massive quantitative easing, where central banks have found it very difficult to raise inflation expectations from very low levels. And the traditional Phillips curves, which sort of explain the relationship between inflation and unemployment, have become much flatter, probably linked to reasons of globalisation. So I think every central bank around the world is finding monetary policy more challenging these days, but I still think the target's appropriate. Did you want to add anything, John?
I mean, was the question, do you think it's higher or should it be lower? Which way were you going?
I would venture no opinion on it.
I mean, because there's interesting. I mean, there is a school of thought. Maybe in this time you should have even a lower target. In part, what you were seeing is lots of countries who are doing QE, very, very accommodative monetary policy because they need to fix their own economies, but are spreading their problem to the rest of the world. And you're seeing that in New Zealand, and in Australia, in Canada, in Norway, Sweden. As the exchange rates appreciate in those economies, they're having to run very, very loose monetary policy just to hit their inflation target, and that creates tension with asset prices. The risk, of course, if you react and change your target, that does very strange things to people's expectations, and you might do it exactly at the wrong time, just when the world starts to back away from QE and reverse everything. So changing targets is a very risky thing to do.
And just the other question I had was, you talk a lot about the dairy sector influencing the terms of trade, and I guess they were cited as one of the 3 key risks to the financial sector. I guess as one of the spillovers from cutting the rates today, do you see that propping up the I guess, heavily indebted dairy farmers and insulating them from perhaps some of that negative cash flow that they're operating at the moment?
I think there may be 2 things that could help. One is the exchange rate impact, potentially, that lies ahead. And secondly, the cut in floating rates. I mean, if you look at the dairy sector debt's roughly around $30 billion. It's large. And around half of that debt is owed by 20% of the farmers. And we know that, or we think that, roughly 25% of farmers have negative cash flow at this point. a lot of the farm lending is on floating rate loans, so this should help in that respect.
Governor, the New Zealand dollar's already dropped 2 cents in relation to the US dollar. Is that roughly what you were hoping for, or were you, I mean, is that too much too fast, or is that roughly on target?
I'll just leave that to the market, I think. Well, thanks very much indeed.